Is your team not performing well? Is morale low and turnover high? Are you falling further behind the competition? I'm here to help. I'm Shani Magoski, and this is the Leadershifter Show, where business strategy and culture finally meet. Explore shifts of all kinds required to build cultures of trust, engagement, and execution excellence. I promise I am not your typical boring leadership consultant, and I will help you and your team get your shift together. Hello, Leadershifters, and welcome to another episode of the Leadershifter Show with yours truly, Shani. I can't tell you how over the moon excited I am to introduce you to today's guest, Beata Kirr. Not only are we former Goldman Sachs colleagues, we worked together in the early aughts in the Chicago office of the equities division, which was quite an interesting time. But since leaving Goldman, Beata's career trajectory has been not only impressive, but super interesting. She managed $100 billion for a very prominent wealth manager. She also started their version of impact investing. She created the Women and Wealth Institute. She publicly speaks and gets interviewed by multiple media outlets on these topics. She is such a wealth of information on the topic that we're going to discuss today, which is ESG and impact investing and what that looks like. So if you don't even know what the acronym ESG stands for, and you're not sure how it differs from impact investing, and you want to hear about models for what great looks like in this space, this is the episode for you. Beata, welcome to the Leadershipper Show.
Shani, wow, what an introduction. And I can't believe your joy. Your joy is matched by my joy. It's so great to see two women that, we crossed paths so long ago. We went on very different paths, and I have an equal amount of respect for how you've built your career with real intentionality and purpose around what you love to design your life around it. And it's so awesome to see in the leadership projects how you're helping people through not only this podcast, but all of the work you're doing that's really, so individualized to help people grow. So it's awesome to be with you. Namaste, as we might say.
I so appreciate that as well. So I always like to start with personal stories so that viewers and listeners can start to get a sense of the human being that is joining me on the show. As I already mentioned in your introduction, you worked for some very big household name companies. And recently, really very recently, earlier this year, you made the very gutsy decision to leave that world and move to a small, purpose-driven startup. So number one, tell us about the Copia Group. And number two, why did you make that shift?
Well, thank you for starting with that. And again, it's so aligned with this idea of purpose and values and vision and living your values that I know you talk about a lot. Well, the Copia Group is a newly formed impact alternative manager based in Chicago. And we're focused on really bridging the wealth gap in America by getting growth capital, whether it's for acquisition or simply growth for business need, to lower middle market companies. So that's companies that have between 5 and 150 million in revenue. And in particular, we're really partnering with these companies not only to provide them credit or capital for their growth, but as a partner on what we call a journey around inclusive mobility. So we're looking for companies that are sustainable. And what we mean by that is companies that build cultures where people want to thrive and stay with low turnover rates and have opportunities to continue to grow. And we do have a particular focus on diversity. We're looking for the majority of our deals to be with ethnically diverse or women-owned business operators. And the reason for that is, unfortunately, because there's been really systemic lack of access to capital, whether it's the traditional banking market or fund access to capital, so that these businesses can continue to grow and thrive. And so that's effectively what the Copia Group is doing. We're a 5-person organization. We're a newly formed business, about a year old. I'm celebrating my 6-month anniversary at the organization. And you asked about the change. It's a huge change. I used to have a team of almost 50 people reporting to me alongside my awesome co-head and partner at my former firm. And you're right, we did oversee about $100 billion of assets for tens of thousands of clients and hundreds of financial advisors. And it was a 16-year career at a great organization full of great opportunities. Very difficult decision to leave, an agonizing one. I probably agonized for too long, but I did eventually make the decision. And I really made the decision because, honestly, I looked at the fact that I had been in one organization for 16 years. I started to think about it on my 15-year anniversary. And that anniversary coincided with a birthday for myself, and unfortunately with a funeral for a dear friend, an illness that I had shingles. If you're over 50, my public service announcement of the day is run to get that vaccine. I don't care how painful it is. I don't care how annoying it is. Trust me, you will be better off with the vaccine. But I had those moments, they all combined in a very short window of time. And I just thought about the next 15 years. And I thought, what do I want my legacy to be? What is really driving me? What's the purpose and passion? And the combination of that really drove me to this idea of impact investing. And in particular, I had a belief that it was best executed in private markets, which of course are harder to do, tends to be at smaller firms, not big publicly traded firms, although there's some that do that. But I really set upon a search to find something like the Copia Group. And I was really fortunate. It was really fateful that the Copia Group was forming around me at a time where I was having this journey of my own. And so I made this huge change, which I can say 6 months into it, it's scary. You have to be very brave. I get now why people look at these decisions and say they're a big deal, because your identity was one thing and it is now a completely different thing. And you have to really push through that and own that and move forward. And so, in short, that's a little bit about the story.
Right. Well, as I say to my clients all the time, what you do for a living and for whom you do it is only one part of your identity. It's just I think we not blow it out of proportion, but it gets a disproportionate amount of attention in our lives because we spend so much time at work. But, that's a topic for another podcast.
Yeah, it's a good topic. It's so true.
Well, I applaud you for the move. I know how bold it was and what you are up to. And by the way, the Copia Group was founded by another former colleague of ours, Chandran Thomas, who also was a very senior person at a very giant wealth management division of a very giant bank. Anyway, so tell us a little bit about the founding story of Copia that attracted you.
Well, first of all, Chandran Thomas is an incredible guy. And, you can look him up and Google him. But he was, Shani, the three of us worked together at the same place at the same time. So depends who wants to go first in describing him. But it's a pretty rare person that you work with in financial services who, from the outset, in their kind of moral fiber, just thinks about things very differently. And it doesn't mean to say that all people are bad on Wall Street, but let's just be honest, it's a profit-driven culture. And what was one of the things that was very unusual about Chandran from 20 years ago that I remember was that he was a reverend on the weekends. And you can see that demeanor and just how he engages. He's really a teacher. And he's a visionary in terms of how he engages with people and thinks about things. And so as I was on this personal journey to find this combination of purpose and passion, and then, impact was another word that kept coming up for me, I reconnected with Chandran. We had stayed in touch, but hadn't seen each other for a while. And I said to him, look, here's what I believe. I believe that impact is best approached in private markets. And why do I believe that? Because there is more of a long-term orientation on success. You're not in this public company quarterly earnings focus. And no matter if a company has the best of intentions as a public company, so many lines of business, so big, so many conflicts in how you measure impact, if you will. It's frankly a lot simpler in smaller private firms that tend to have concentrated lines of business. And you can impact these businesses early on to build this inclusive culture, right? So I had this idea and this thesis, first of all. And then second of all, I had this idea that I could be what's called a chief impact officer, which was kind of a title I made up. I mean, that role does exist in a couple of organizations, but it's not a widely known nomenclature. In fact, it's most often the case in nonprofits, right, where they're measuring the impact of their grants. But the reason I thought it could exist as a role is that it could be this amazing combination of the investment responsibilities that I so enjoyed in my former life, really with participation on the investment committee, but a lot of focus on impact measurement, as well as thought leadership and then engagement with clients and the companies and the community. And I laid all this out, and Chandran had this amazing poker face because he was at that time still employed at this large organization, not to be named, a very big bank. And he said, "You're not alone. There's other people that think like you do. And it's so great to reconnect." And 2 weeks later, he announced he was leaving. And I see this in the press before I hear it from him. I'm like, oh my God, what happened here? And so what happened was, 6 months later of conversation where I had effectively laid out a very similar vision to what he had already believed. And he had been architecting the creation of the Copia Group with a specific focus on providing credit to business owners. And the reason that he had focused on credit was because the wealth gap is really large in America. When we say the wealth gap, it's what is your household net worth effectively. And if you're in a household where your primary breadwinner is a woman, the wealth of that household, if you're a white woman, is 56 cents compared to $1 if it's a household led by a white man. Now, if you're a Hispanic woman, it's 11 cents. Oh. And if you're a Black woman, it's 5 cents. Oh. So this is a study that's done by the Federal Reserve, and it's done every 3 years. And that data was from 2019. The latest data will come out this, actually any minute now. So we'll see if it's improved or worsened, but I don't have high hopes for it improving because inequities for a period of time in COVID shrunk and then they gapped out again. As we know, wealth is incredibly concentrated in America. But in short, those statistics are staggering and they're persistent. And his thesis was around this idea that we're really affecting the Copia Group. If we can be a bridge for growth for companies that are in particular ethnically or gender diverse as business owners, we're filling a gap. We're filling a gap to create wealth because wealth in America is often driven by business equity, whether it's private or public. And so it's a very well thought through thesis on how we can play a role, what makes us impactful as investors. And so we're looking to be strong investors first and foremost, but alongside that strength of investment return is real impact by providing a path to inclusive mobility through this capital.
Yeah. So we've probably used the word impact at least 25 times.
Yeah.
And I don't know, the 10
already
we've been speaking so far. So explain to the leadershipers first what ESG stands for, because some people don't even know what it stands for. Literally, the 3 words in the acronym. I would say a lot of people probably know the BUZZ acronym, but don't even really understand what it means, and then distinguish that from impact investing.
Yeah. And I'm glad you're asking for the definitions because I do think we're at a point in the world right now where we want to get away from the acronyms. We want to get away from anything that makes it more confusing than what it already is, right? We want this to be clear. And the more clear something is, and the more it's tied to the essentials of business, opportunity and risk, the more ultimately impactful it will be. So let's get to your question. ESG, environment, social, governance. This was originally formed as a framework, in many ways, what I would describe as measuring risk. So what are your carbon emissions? What is your carbon footprint? Very common questions around the E. Social, very common questions tended to be around diversity, right? And benefits and pay, perhaps pay gap would be examples of metrics in the S. Governance tended to look at things like how often your board turned over. Interestingly enough, there was this comment around how pale, male, and stale is your board. It's not particularly PC to use that description, but it's very vivid. The reality is that a lot of boards had a lot of directors that were on for a very long period of time, and that was shrinking their ability to think broadly about the key issues for the company. And that's just one example of governance questions that could be asked around a board. So I look at ESG metrics as really essential to monitoring risk of an investment. But there is a big difference between the topic of, what is an ESG investor, or what would an ESG fund be versus what would an impact fund be. And the biggest difference is the idea that if you're going to be an impact investor or an impact fund, whatever form you're investing in, you start with impact as essential to your goals. So it has to be material. It has to be there from inception. And it has to be intentional, right? It's not accidental that you're asking questions about what is the impact of my capital going to be. I think about it as saying, like, you want to follow the trail of your dollars and understand how those dollars get dispersed in a company, again, public or private. Who are the beneficiaries of that? What are the positive and negative impacts of that? And then you commit to really measuring progress of that impact. So I talk about what's called the alities with impact, the intentionality, the additionality of your capital. If you didn't give the company that capital, what would have changed? What would have been different from an impact perspective? And the materiality. So intentionality, additionality, and materiality. And these are widely regarded terms around impact. And I view them as musts to be really a forward-thinking impact investor. So in short, in many ways, ESG is really important. But in many ways, I view ESG as almost a backward-looking risk measurement exercise. And true impact investing is, again, having all those alities and being forward-looking in terms of measuring that.
Right. And I also feel like ESG has become performative. Like, oh, look at our big section in our 10K about how transparent we are with our ESG. And it's like, okay, that's great, but so what?
Well, I don't want to insult ESG in any way, right? Because the movement was very important and there's been tremendous progress made. But like you said, the greenwashing aspects are real. That there was a kind of pile-on mentality, or at least it seemed that way, that suddenly one fund after the next said they were a sustainable fund. But what made that fund sustainable? And like everything else, it's important to walk the walk and not just talk the talk. You could say the same thing about the other three-letter acronym that's getting a lot of attention alongside ESG, and that's DEI. So again, back to this thesis that we should stop talking in acronyms, and we should start talking about what's important. And what's important in terms of investing is, there's tremendous power in capital deployment. Again, whether it's in the public markets or in the private markets. And that's one of the best parts about being either an allocator or a fund manager, that you think about the strength you have for that capital. You have a voice with your capital. And I tell people too, it shouldn't just be what you're investing in. We all have a voice as consumers, right? What companies are we supporting? And so this idea of impact, you can take it really to the nth degree and decide how you want your dollars to be deployed and to whom. And that makes a difference.
Yep, that's great. Thank you for that explanation. Let's go from the teaching of it to a practical example of it. And the beloved company that we decided to focus on pre-show is Patagonia. And as a former Coloradan and outdoor enthusiast, Patagonia is one of my favorite brands. But more than that, it's a company that I just have immense respect for. The CEO and founder, Yvon Chouinard, is a visionary. And, I'll let Beata explain the impact pieces. But the bottom line for me is what they do there is really the engine behind the great culture that they create. We all know that I'm obsessive about culture. So
obsessive about culture and probably have a lot of Patagonia fleeces, right? So,
oh my God, fleeces, ski jackets, boots.
There you go. Well, yeah, there's conscious consumerism at work, right? You've decided to reward the company for the values that they espouse. And so you could do a whole show on Patagonia, right? So to be clear, for all kinds of, purposes, we're not investing in Patagonia, right? But at the Copia Group, we're only investing in private, small companies. But I love the idea of providing it as an example because of a lot of things. What makes a company an impact-oriented company is so specific to the company, and there isn't a formula that says this is the way you have to do it. Yes, They are what's called a certified B Corp. So there is a formula now where you can get an accreditation and go through a set of standards that says the type of company that I am meets this criteria. And that's a very high bar, a lot of respect for the B Corp certification. Second, they registered in California as what's called a public benefit corporation or California benefit corporation. They did this years ago. That was another way of signaling to the market that they intend to use their profits for purpose. The third, many, many years ago, they committed to this idea of giving away 1% of their sales to the environment, to the planet. And then they convinced other companies to join them in doing this. This is a little bit like Warren Buffett and the Giving Pledge. When you're using your power collectively, there's also an impact investing. One of the real criteria for being a true impact investor is giving back to the impact community by sharing your processes and methodologies that are unique to your organization, really for the benefit of the impact community. Because the impact community, in terms of investors, is still a new community. And there's this parallel with what Patagonia did recently, a couple of years ago before the pandemic. They restructured their corporation into a fashion where effectively they put it as, instead of going public, they're going purpose. Basically, the founder was deciding how to create this legacy, and he didn't want to give the company all to his kids. And he didn't want to sell the company because he was concerned about what the new owners would do with their employees and how they would run the business. And he specifically said he did not want to go public because he didn't trust a public company could do good as much as they say they're going to do because of that short-term focus we talked about earlier. So instead, they created basically a new structure in the US. As far as I know, no other US companies had this structure where they took the voting shares and they organized it in a way where the primary purpose of the company was going to be purpose and that nobody else could buy it ultimately. And it was going to be protected with this combination of a nonprofit and a public company, a nonprofit and this purpose-driven organization, but that it was protected through this pretty complex structure in a way where it's like a steward ownership structure. It's a different type of ownership transferred to a special trust, which is focused on purpose. And the purpose is the planet. So it's still a for-profit company. It's just that the extra that's above and beyond will always go into this purpose-driven trust. And so, as it turns out, it's not unique in the world to have a structure like this. There was a couple of other European companies that have done something like this, but my understanding is in the US, they were the first. And I just point that out because I think it's really important to be open-minded as an impact investor, that each company or each investor can think of unique ways to be impactful. I think one of the pitfalls is if you think there's one formula for everything. Now, there is a formula for carbon emissions. There is a formula, right? That is something that is discrete. There is a formula for measuring diversity. That is discrete. There's a formula for measuring the pay gap. But the same criteria shouldn't apply to each company because each company is in a different space in their impact or inclusive trajectory in our world. And so I think being customized, being unique, makes a lot of sense as an investor. And I think as the impact investing community evolves, creative structures like what Patagonia did, really being a leader in this space and creating a new way to think about things is something that, I welcome and hope many companies and other investors continue to do.
Right. I thank you for sharing all that stuff. I knew about the B Corp and the 1% for the plan. I didn't know about that new structure. And of course, now I'm going to go do research on it just because that's what I do. So, some other things, again, as a conscientious Patagonia consumer, it's not just that they're giving money; it's part of their product offering too. Organic cotton, I have
Recycled materials,
recycled something. So they're giving their money and they're putting their money where their mouth is. So there's just such.
It's a purpose-driven company. I mean, it's truly the meeting. I mean, there's so many things they've done. They ran a campaign that was titled something like, "Why do we buy so much?" That was really encouraging their customers not to buy as many things from them because it's wasteful, right?
Right. And that's one of the reasons the quality is so good. People have Patagonia for 20, 30 years, one item. And most companies would say, that's crazy because then people aren't buying continuously because it's like Oh, that's what's so great about it. And that's what keeps me loyal to the brand. And speaking of loyalty,
Right.
like, and how the purpose drivenness, if that's a word, really is like the water that their corporate culture swims in, and it causes people to be so loyal to them as an employer as well. Like once upon a time, I used to look at their website weekly to see if there were jobs I was qualified for, because it was like a dream for me to work for that company. And the reality is, for there to be job openings, like people have to die or retire because no one leaves that company.
There's a lot to be said for this idea of what is a sustainable company. At the Copia Group, we're not just focused on sustainability from an environmental perspective. And why do I say that? Because a lot of the impact investing to this point has been environmentally oriented. By the way, as it should be, right? We're in total crisis on climate. We need dollars to go towards this. Carbon emissions are trackable. Sustainable agriculture and other alternatives for energy creation are really, really important investments for us to be making, and tremendous opportunities. But it's not the only way to invest in impact. And what you just talked about with Patagonia is, let's talk about people. Let's talk about the S in ESG.
Yeah.
And the S has really been underinvested. And, you talk about how you were just so interested in working for a company like that. And we're talking about that at a time where some of these strikes have been settled, but some have not been settled. This has been the summer of strikes. These have been the largest labor strikes that we've seen in America in decades, because the employee workforce has become much less unionized in the US, down to 10% from what I think was 30% in the 70s, where there was cost of living adjustments baked into people's paychecks, right? The last time there was inflation. Well, that didn't happen this time around. And here you have, not only in Los Angeles, the actors strike, but you had the largest healthcare strike in history with Kaiser Permanente. You have the auto workers on strike. You have some Starbucks workers on strike. So look, companies cannot afford to ignore their workers, to ignore their culture, to ignore a living wage or healthcare benefits. And so that's really what we're focused on. When we talk about inclusive mobility, we talk about working with businesses, providing them capital, where we are going to be measuring progress on those fronts. We focus on diversity and inclusion, but that's not the only thing. That's really the beginning. You want a workplace of psychological safety for all, but you want benefits to grow. You want awareness of employees' financial situation. And companies can't change this overnight, right? Like anything in life, until it's a crisis, people don't focus on it. So, with a strike, then they get wage increases. But we want to partner with companies on a journey where they're anticipating that issue, where they're measuring that issue, and they're committing to progress. So a company like Patagonia, nobody's perfect. And they even admit for a while, they did some research on their supply chain. And the supply chain, not surprisingly, didn't have the best wages or the best treatment of their workers. So they signed up for a commitment to supply chain transparency and living wage analysis on their, not just who's manufacturing in the US, but where is everything made? And in the garment industry, as you can imagine, right? So again, here too, they're a leader. But so the impact doesn't end, really. It's a constant battle, if you will, to see where you are, what's material to your business, and what makes you a purposeful company. So I digress a bit, but I think your point on Patagonia and what an amazing place they are to work, and that lack of turnover that they have just shows that being a purpose-driven company, knowing who you are and your values, can really be incredibly profitable for you, because turnover is very expensive.
Absolutely. So let's stick with the S for a second, because I agree it's DEI, it's how you treat your employees and, creating that psychologically safe environment. It's also how companies handle burning social issues. Mm-hmm. And let's just name a few elephants in the world, not just in the room. Let's just go as far back as George Floyd, mm-hmm. and to the current time with the Israel-Gaza. And I don't want to get into the politics of any of it, but just from a framework perspective, what do companies need to keep in mind if they're trying to honor the S?
Well, the first thing they need is a framework, and they need to know what their values are. And that's sometimes the hardest work for companies to do. Because I think if you force leadership in a room and you say, what matters most to you? What do you want to stand for as an organization? This is work that needs to be done in order to respond to what I call the whack-a-mole of social issues that they're going to have to face. Because it is true that the millennial workforce demands values assessment from their employers. They don't feel like, there was a survey done recently that said something like, I'm going to mess up the percentages, but that individuals in America, it was through a PR agency, trust their CEO more than they trust anybody in government or their family to tell them, what's a values view. And it was a shocking survey because it showed the importance of the CEO in particular. Their voice for workers was incredibly trusted. It's really, we have to dig up the survey and find the exact numbers as a follow-up because it shocked me, but it is a survey that came out. And PR agencies talk about it a lot right now in terms of how they're guiding companies to respond. And the answer is that no response is a response.
That's right.
And some institutions have said, let's just say academic institutions have said, because of academic freedom, we're not going to comment on this or that. We're going to stop short of hate speech, but we're going to allow both sides to be there. And we're simply not going to comment other than our sympathies are extended, right? Now, for companies, somebody like Patagonia, let's stick with that example. I haven't tracked them recently on social issues, but clearly they have put themselves out there as a steward of environmental activism. So I would expect them to comment on everything environmental, right? I would think their employees would expect them to comment. That doesn't mean they have to comment on everything else, right? So I think there's this idea of knowing who you are and not trying to be everything to everyone. And, if fairness or equity or equality or empathy are values that you would put in your top 5 values, then I do think as a company, you should create that psychological safety for your employees around conflict and say something as simple as, we understand our people are suffering on all sides right now, right? Whatever that situation may be. And we want to encourage open dialogue. We want to encourage trust and honesty. We want to create safety in the workplace environment. So I don't have all the answers to this. I just think a framework, a value assessment, and transparent communication and consistency are really important. Because the real problem that we've seen in corporate America, just using the examples you gave, is a lot of companies that spoke out about one of those situations did not speak out about another one. Not to name which one, but that was not consistent. And that is a problem because then it appears you're favoring one group over another group, right? So if you're going to make a statement here, you have to make a statement there. And so I think that consistency is what really leads employees to believe that their company is walking the walk and not just talking the talk.
Right. So I'm just thinking with the hat on of entrepreneurs, small and medium-sized businesses who maybe didn't start as a purpose-driven company, but are very much interested in moving in that direction. So just a few of the pieces of advice you've given in the past, few minutes, know your values and, shameless self-promotion here. If you need help with your corporate values and mission and vision, it's one of the things I do. And I'm super passionate about it because if those foundational elements are not clear and consistent, then nothing else matters. Okay, so know your values and the communication, both how you communicate around conflict situations in the workplace to create that psychological safety and publicly communicating transparently and consistently. What other advice would you have, like some baby steps for, again, these small, medium-sized companies that want to do more?
Well, I can just speak about some of the companies that we're looking at that are small companies. I mean, yes, they have revenue in the millions, so they're not, your mom and pop small business next door. They've been in business for years, some of these companies, but they range in employees from, let's say, 10 to 250. So that gives you a sense that these companies are very much kind of the lifeblood of America. It's where small businesses grow up and ultimately are made. It's what's called the lower middle market of types of companies. And what we see is a huge variation in policies that are in place. And this advice might sound super boring, but as usual, if something is not written down and if it's not measured, it is not going to be a priority or something you make progress on. And everybody hates that advice because it's yet another thing to do. But let's just be honest here. If you don't have a sexual harassment policy, if you don't have a diversity policy, if you don't have a diverse supplier policy, if you don't have an anonymous complaint procedure in place, what environment are you creating for your workers? Will you be creating an environment that promotes psychological and physical safety without those things in place? And now each of them vary in importance, right? But these are the types of discussions that we would be having with our companies before you then talk about awareness around a living wage, awareness around benefits, awareness around, I think one of the most important benefits to pay attention to right now is what's called the secondary caregiver benefit. Listen, the primary caregiver benefit is super important, and lots of people focus on this first, and they should. And we still don't have, mandatory national child care in America, and that's a problem. But here's an interesting fact. That companies that emphasize the secondary caregiver policy, and the reason I call it secondary and not husband is obviously people are in same-sex relationships. It doesn't have to be that you're married. It's whoever is the second person that is helping you with your child. Secondary caregiver policies. The more that there are generous policies on that front, and the more people take it, the more diversity there is in that company. Because the women feel appreciated because they need the help. Right. And I think that's like a hidden gem that this is something I'm really focused on right now because it's not paid attention to as much as the primary. I'm not in any way minimizing primary leave. I'm just saying sometimes it's that second layer of detail that really matters. Right. And so, my old firm, I just met with somebody. I mean, it's awesome. He just took 4 months. And I give them huge, huge credit. I give the firm huge credit and I give the individual huge credit because it takes two to tango. The secondary caregivers have to feel comfortable taking the time off. That allows the firm to think differently about the primary caregivers in that time off. And suddenly everybody's a caregiver, which is the reality of life when you're raising kids. And there's a different appreciation in the workplace. And it's not a kind of she versus he situation in that setting. So that's a little nugget that I've come upon in the last 6 months that's really intrigued me. I think it's really important as the future of benefit policy.
Really great suggestions to take a look at all the different functional areas because there are impacts to be had across every functional area. It's not just HR.
Right.
Yeah. So I could talk to you about this for another few hours, but
me too, unfortunately. But our listeners might not be so interested in that.
Yeah. So I want to honor listeners' attention spans and start to draw to a close. And first of all, thank you so much for the wisdom and the insight and even the very digestible explanations of this stuff for people who don't live it and breathe it like you do. Any last words or anything that I didn't ask you or that you want to share?
I guess I would just share that I'm so excited about the impact investing movement, that I really think that we're at a new frontier. And despite what you may read in the local press about pushback, and look, there is pushback on everything. You don't make progress on anything that's not difficult, right? Making progress is difficult to begin with, but I have a lot of optimism for this new wave of investing and new wave of investors that, by the way, happen to be led primarily by women and millennials, right? And as wealth turns over in this country, a different type of investor is asking different types of questions. And I just feel like it's a very exciting time with the IRA legislation really motivating climate-focused investing and alternative energy investing. And I think we will turn a corner similarly around people-based investing, the S. So I would just leave our listeners with that there's a lot to be excited about, that they should think about the power of their check, physical and literal, right? Virtual and hard copy in both the purchasing decisions they make every day and in the investing decisions they make for their life. So I really appreciate the opportunity to talk about it.
Excellent. Well, gosh, thank you so much. It was great to see you. Leadershifters, thanks for joining us today. Beata, how can people reach you if they have questions?
Well, they can email me at bkerr@copiagroupllc.com, or I'm also on LinkedIn. Would love to hear from people there.
Okay. Thank you so much. And Leadershifters, until next time. Thank you for listening to today's episode. Go to theleadershipproject.com to sign up for the Scoop newsletter and explore all the resources from this podcast in the show notes. And follow me on Instagram at The Leadership Project and LinkedIn under my name, Shani Magoski, for inspiration and content about all things leadership. Make it a great day.